Welcome back to the channel, everybody. In today's video, we are going to be looking at the biggest financial myths that you will hear in your 20s from people around you, people on the internet, whatever it might be. So let's go ahead, let's hop into the video. So first up on the list here is the myth that investing is gambling. And this is typically one you'll hear from people who aren't super financially literate. Now look, I'll be fair. There is some forms of investing that absolutely look like gambling, whether it's day trading or call options, maybe some meme coins, right? Chasing stocks. Like I totally get that. That starts to look like gambling at some point, but long-term investing into diverse index funds is completely different from gambling. When you buy something like the S&P 500, you are not betting on a single company. You are literally buying ownership of hundreds of businesses that produce real products, they generate real profits, and have historically grown over time. And the irony with this is a lot of people will call investing gambling while literally leaving all of their money sitting in a checking account, losing purchasing power every single year due to inflation. But calling long-term investing gambling is completely false, and it will hold a lot of younger people back for years because they'll miss out on all that compound growth that they could see if they actually started investing their money. So this one will cost people years when it comes to their financial freedom. Next up is you'll hear a lot of people say, if you make more money, you're going to automatically become wealthy. And I think this is one of the biggest financial myths because it sounds very logical, because people assume once they get that raise, they get the promotion they've been working for, they get that higher paying 6-figure job, all of their money problems disappear. And we've seen all types of people who make 6 figures, 7 figures, even 8 figures, and they're all still broke. And the reality comes from the fact that income helps, but income alone does not create wealth. What you do with that income is what matters the most. And the common trap that people fall into is they'll increase their income and then immediately they increase their lifestyle right alongside of it, whether it's a bigger house, new car, eating out more vacations, just more stuff you don't actually need. So even though they're making more money, their financial situation doesn't really change and sometimes could even get worse. So this is one of those financial myths that is just extremely misleading. You have to be very good with money, even if you're making a lot of money, to actually become wealthy. The next myth you hear is people saying that you don't need to worry about retirement in your 20s. You're 20 years old, typical retirement age is 59 and a half to 65, that you got, another 30 years, 40 years before you get there. You don't need to worry about retirement, but I'm here to tell you that's completely false. Someone who invests $100 a month starting at 22 years old is often going to end up with significantly more money than someone who waits till their 30s and invests much larger amounts. And that's the true power of compounding. Now, I'm not saying that you need to max out every retirement account at 21 years old, but completely ignoring retirement because you're young is a huge mistake that a lot of people make. And I'm all for even very small contributions. Like even if you can only do $10 a week, $40 a month, whatever it might be, just starting and being consistent about it is going to help you out as time goes by. So this one right here will cost people years of financial freedom. Next up is the myth that wealthy people are good with money. And this kind of goes hand in hand with making more money equals wealth. And what happens is you'll see a lot of people online who are quote unquote wealthy. You see a lot of sports athletes, actors, stars, whatever it might be. Just because they are wealthy does not mean they are good with money. It is extremely easy for all these sports people, all these celebrities to make millions, if not hundreds of millions of dollars, and then go completely broke. And the worst part is when these people are giving out advice to the general public because they believe that now they have a lot of money in their bank account that automatically gives them a voice in the financial space. And wealth can come from a lot of different things. It can come from inheritance, it can come from luck, it can come from a business, just a lot of different factors. And it doesn't automatically mean someone is financially literate. So the reason I'm bringing this one up is just be careful who you're taking advice from online. Just because they're rich and flexing a supercar or a really nice house doesn't mean they're actually good with money. So this one is one of those ones that's just extremely misleading. Next up is probably my least favorite financial myth, and that's the one where people say you need to be rich to start investing. That was the whole reason I made my YouTube channel in the first place, because when I started this YouTube channel, I was making $19 an hour and I was still investing my money every single week. And the reality is that investing is one of the ways normal people like you and me, we become wealthy in the first place. More than likely, as much as we all want our own businesses and we all want to make it big on social media and we all want X, Y, and Z, the majority of the way that we're going to become millionaires is through long-term investing. All of you guys right now could take $5 and go invest it. And I know people in the comments are going to be like, there's no point. It makes no sense. Why would I invest $5? It's because you're building the habit. So while you don't have a lot of money, you get really good at managing your finances. That way, when your income scales, you get even better at managing your finances. And you don't fall into the traps, like I mentioned mentioned prior, where all these rich people are going broke. And also, as mentioned prior, when you're in your 20s, you have the most time for that money to compound. So even $5 a week can do a lot over the next 30 to 40 years. So like me personally, I would rather see someone in their 20s today investing $50 a month than waiting 5 years and hoping they have an $80,000 paying job to start investing $100 a month. So this is one of those ones that literally cost people years of financial freedom. You can start investing today, even if you're making minimum wage. Next up is the myth that you need a financial advisor. And for some people, especially older people, financial advisor can be extremely beneficial. The myth is that everyone needs a financial advisor, or just because you're investing or trying to save money, you need a financial advisor. And a lot of people think that investing is this incredibly complicated thing that requires a professional to manage all the decisions you make just to take a cut of it at the end of it. And some of the most successful investors are literally doing the same boring things year after year. They're just consistently investing into diversified funds and leaving them alone. And you can absolutely do that yourself. You don't need a financial advisor to tell you to do that. So if you're in your 20s or your 30s or your 40s and you have a Roth IRA and a 401k, you probably don't need to pay someone a percentage of your assets just for them to tell you to buy index funds like you're already doing. So obviously financial advisors can be helpful, but for the majority of people, I don't really think they're a requirement for actually building wealth. So this just sounds true, but it's not. Next up is the Dave Ramsey special that all debt is bad. And this is one of those financial myths that's technically, it is close to the truth, but not quite. The reality is there's different kinds of debt and they all kind of have their own weights, right? So like a credit card at 25% interest, that's terrible. That is like financial damage at its finest. But having a mortgage, certain business loans, low interest debt that helps you build wealth, that can be a completely different situation. Now, don't get me wrong. Being debt-free is a goal of mine. I think it should be a goal for everyone. Just you have to understand that not all debt is created equal. So I think the thing people need to focus on is not necessarily avoiding debt at all costs, but it is understanding which debt is actually going to help you in the long run and which debt is really holding you back in your finances. So I think this is just one that sounds true, but isn't necessarily true. Next up is people telling you that you need a six-figure income to actually build wealth. And this is a huge excuse that a lot of people tell themselves. And what happens is people will not take their finances seriously and they'll put it off until they have a job or income level that they're actually proud of. So they'll say, okay, I'm making $60,000 a year. I don't think it's important for me to take care of my finances, but maybe once I have a $100,000 a year job and I'm making quote unquote a lot of money, at that point, I'll start taking my finances seriously. And that's a huge trap a lot of people fall into. Now, obviously, making more money does make the financial wealth process a lot easier. No one is arguing against that. You can learn how to budget, you can learn how to save, you can learn how to invest, and just build good financial habits at almost any income level. So this is one of those ones that, in my opinion, is just extremely misleading. Next up is you can time the market if you're smart enough and or you do enough research. And what happens is this convinces people to sit in cash for years because they wait for the quote unquote perfect time to actually get their money in the market. And this is how the typical journey goes. They're gonna wait for a crash, then the crash is going to happen, and then they're going to wait for it to go a little lower, then it starts going back up, and they're waiting for confirmation whether it's going back into a crash again or going back up again, then it reaches new highs, and then they're still waiting for the next pullback. People still believe they can time the market when there's literally teams of analysts, supercomputers, and decades of experienced investors who struggle still to this day to consistently time the market. So what makes you think that you're going to actually be able to do it from your couch looking at Robinhood every day? Now, can people get lucky and buy at the bottom? Of course they can. Can someone occasionally call the top of the market? Yeah, of course. The problem is that to successfully time the market, you have to be right twice. You have to know when to get out of the market and when to get back in the market. And that is where a lot of people just screw themselves. So for the average person, time in the market will always be trying to time the market. Just get your money invested on a consistent basis, just invest. This will cost people years of financial growth. Next up is the myth that you lose money if the stock market crashes. And this one is technically true, if I'm being honest, but it's incredibly misleading. If the stock market crashes and you panic sell everything, then yes, you absolutely lose money. But if you're a long-term investor and you don't sell, you haven't actually realized that loss. The value of your investments might be down temporarily, but you still own the same shares that you owned before. In fact, when the stock market crashes are often some of the best times to actually get your money invested. It's almost like, think of it as like a fire sale. If you really enjoy buying the S&P 500 when it's expensive, why would you suddenly not want to buy it when it's 20, 30, 40% cheaper. Every major stock market decline in history has felt extremely terrifying while it was happening. Yet over the long run, if you just zoom out, the market has continued to recover and reach new all-time highs. And this is one of those things that will keep people sidelined because they're scared to lose money in the stock market, when if you just invest for the long term and don't panic sell, you're going to be fine. So this is extremely misleading. Next up is people telling you that a credit card is bad. And this, I lean both ways on this, because at the end of the day, a credit card is a tool. The problem is a lot of people confuse the tool with how it's actually being used. So if you're carrying a balance every single month, you're paying plus 20% interest, and you're buying things you can't afford, then yeah, a credit card can absolutely be a financial disaster. In my opinion, the credit card is never really the issue, it's the person, right? It's user error. If you are really undisciplined with your finances and you max out every credit card, then credit cards can be some of the most financially damaged things out there. However, if you are extremely disciplined, you pay your card at the end of every single month and you use it for the right reasons, then they can help a lot of people. My overall consensus of this is that most people should not use credit cards simply due to the fact that they're not disciplined enough to use them. If everyone was disciplined to use credit cards, credit card companies would not be as rich as they are. But overall, I think this is one of those ones that sounds true, but technically isn't as true as people make it out to be. Next up is the myth that renting is throwing money away, and this is one of the most repeated financial myths of all time. People act like the second you pay rent, that money disappears into a black hole. You're broke now. What are you doing? Why didn't you not buy a house like your parents told you to? And the truth is, renting and owning a home have its own different costs. You know, when you rent, you're paying for a place to live. When you own, you're paying a mortgage, property tax, insurance, maintenance, repairs, HOA fees, closing costs, and a bunch of other expenses that people conveniently forget to talk about. Can buying a house be a great decision? Of course, it can be one of the best financial decisions and biggest assets you ever have in your life, but it's not automatically the right choice for every single person. For example, if you're moving soon, you don't really have enough money saved for a down payment, you aren't really sure where you want to live in your new area, or housing prices just they don't make sense, you can't afford it, renting can be a smarter financial move. The problem is that people hear renting is throwing money away and then they rush into buying a house that they can't actually afford. It kind of just depends on your own situation, but overall, I think the renting myth about throwing money away, I think this is just overall extremely misleading. Next up is the myth that carrying a credit card balance will build your credit score. And I think this is one of the dumbest financial myths out there that people still believe. Somewhere along the way, people got this idea that they need to carry a credit card balance and pay interest to prove that they're responsible borrowers. I'm here to tell you, you don't. This is a lie. This is a myth. This is not true. You can build an excellent credit score by simply using your card, keeping your utilization reasonable, and paying the balance in full every single month. So why would you voluntarily pay 20% interest for a credit score benefit that doesn't actually exist? So build your credit, use your card responsibly, pay it off in full at the end of every single month. Don't pay interest just because someone on the internet told you that it helps your score. So this one right here can literally cost people years, because I don't know why people do this. Just pay your credit card off. Next up is the myth that you need multiple income streams to become successful. Social media nowadays makes it seem like that if you do not have a side hustle, a YouTube channel, a rental property, an Airbnb, a business, 3 other sources of income, you are falling behind, you're losing the rat race, and you just want to work a 9-to-5 like a loser the rest of your life. Now, don't get me wrong, having multiple income streams can absolutely be beneficial for your finances. You know, once you've built a strong foundation, diversifying your income is a great idea. But for a lot of people, your 9-to-5 will be the biggest income driver for your finances pretty much throughout your whole life. And also, if you like having a 9-to-5 and you enjoy your job and maybe you're not making, as much money as you want to, don't let people force you into this idea that you need to have, 3 different side hustles to actually make it in life. There's plenty of people who have a 9-to-5, who like their 9-to-5, they make decent money and they live a great life. So this is one of those ones that I think sounds true, but this just isn't true. Next up is the gold standard for boomer advice, where they tell every single person younger than them that you need to own a home. And there's no secret about this, because for boomers and older people, pretty much when you get to retirement age, your home is your biggest asset. And I don't know when this happened, but people started treating home ownership like it's a requirement for being a successful adult, especially in America. It's not. And for some people, specifically ones who have a steady job, good job security, potentially a growing family, buying a house is a great move. For others, renting while investing the difference, staying flexible, focusing on other financial goals, That's the move. So I think overall, this one is just extremely misleading nowadays. Next up is the myth that people tell you should only invest when the economy looks good, stock market's green, whatever it might be. And this sounds very logical until you realize that by the time the economy looks good, the market has usually already moved upwards. For those of you who don't know this, the stock market is very forward looking. It's consistently trying to price in what it thinks is going to happen next and not what's happening actually today. That's why you'll see some stocks going up when the news is terrible or falling while the headlines kind of seem positive. And this myth keeps people in the trap of waiting, right? It keeps people waiting for inflation to come down. It keeps them waiting for interest rates to drop. It keeps them waiting for the stock market to turn green. You can always find 10 reasons right now, even today, to not invest, whether it's recessions, wars, inflations, political uncertainty, market crashes. Something is always happening in this world that points to the fact of you probably shouldn't invest your money. But the people who build true wealth aren't the ones who are waiting for perfect market conditions. They're the ones who are consistently investing that money through the good economies, through the bad economies, and everything in between. So I think overall, this one also costs people years. Next up is the myth that you should pay off your mortgage. And honestly, this really depends on the situation. A lot of people act like paying off your mortgage early is automatically the best financial decision you could ever make. And honestly, I get it, right? Owning your home outright is amazing. Like that's super cool. I hope I can do that one day. But financially, it's really not that simple. If you have a mortgage rate at like 3-4%, maybe 5%, and you're aggressively paying down that while neglecting your retirement accounts, your investment accounts, your savings, other financial goals, you might actually be hurting your long-term wealth at that point. Now, if being debt-free helps you sleep better at night, well, then that's a completely valid reason to pay it off early because personal finance is personal at the end of the day, right? You're going to do what you want to do. So I think the true answer is really it depends, right? It depends on interest rate, investing goals, and kind of your overall financial situation. But I think at the end of the day, this sounds true, but it really isn't. It really depends a lot on your personal goals. You should turn down a raise because of taxes. And this is, I guess, a super common financial myth. Someone gets offered a raise and then they have people in their life telling them, you need to turn it down because it's going to push you into a higher tax bracket. And I'm just here to tell you, that's not how tax brackets work. America specifically runs off of a progressive tax system, which means only the income that falls into the higher tax bracket actually gets taxed at that higher rate. So your entire paycheck doesn't suddenly get more taxed just because you cross that certain threshold. And I've never seen someone get a raise and then end up poorer because of the tax system. And from what it seems like online, this myth has cost people plenty of job promotions and opportunities and just thousands of dollars in lifetime earnings simply because they didn't understand how taxes work. So this one can and will cost people years. So that is my tier list for the biggest financial myths that you will see in your 20s. Let me know which ones you agree with. Let me know which ones you disagree with. And let me know if I missed any because I know all of us have heard plenty of financial myths while we're growing up, while we're adulting throughout our 20s. So overall, thank you guys for watching this video. And as always, I will catch you guys in the next one. See ya.